All right, how's everybody doing? My name is Frank Bunn, and the topic of this conversation is sideways market, trending market, who cares? Because if you do, you're just probably doing it the wrong way. Sideways trending markets are these nebulous concepts people apply. They try to find a strategy that works for either one. They try to second guess it. None of it is quantitative, none of it is focused, very little of it is tactical, and there's just no way to take advantage of it. And I get hit up all the time. People ask me, like, what do you do in a sideways market? I ask them, how do you define that sideways? They don't even know how to define it. They don't even know what it is. They just think that it is that, and it's just a whole bunch of confused mess. So by the end of this conversation, you're going to have a really much better idea of exactly, what you can do with this. Okay. All right. So yeah, you can't worry about it, and you shouldn't worry about it. And the reason that you shouldn't worry about it is because we all know this. We've been over this before. Markets move in two dominant phases. We know that. Contraction and expansion. Okay? This is expansion. This is contraction. Price is stuck in a range. Price is expanding. Okay. All well and good. We don't know, nor do we really care. I know I don't, when that's going to continue or not, or when it begins or when it doesn't. All I know is, okay, I can get a breakout or I'm range bound. It doesn't really matter. Okay, so as a result, if you're going to trade for direction, and that's the key, that's what we're trying to do here. We want to be right about direction. And it isn't that hard. So let's say we take a mean. Let's say we take an average of prices. Okay, so, and we have this average right here. And we're just going to say, I don't know, we're going to use, for example, we're going to use the 30 forward weighted, front weighted average. Okay, it doesn't even matter what it is. You can choose any one you want. It's really that easy. Okay, so what happens is price is going to make deviations around this mean, right? So what we're going to do as analysts of price action, and what I do and what I teach my students to do, is to find, your low risk shorts are going to be in this area with the expectation of a resumption to the mean. And then my low risk longs are going to be down here with an expectation of a resumption to that mean. Okay, so these deviations can be incredibly varied and numerous. A lot of it depends on volatility, all those things that are really, really difficult to measure. But all we got to know is that this happens. And because you know this happens, then you can take advantage of it. Okay, so the next thing, if we're talking about direction, is let's just say that we have this is the signal line. Okay, so this is the line. Once this is crossed, okay, so we now have a trend. So we have our average is going to look like this. Okay, so once that average crosses, then I have these deviations from it. Okay. And then again, my shorts and my longs in here. All right, so all I really need to do is find the low risk entry as soon as I can at the beginning of my cycle. Now the cycle can be anything. In this case, we were talking about the 30 weighted moving average. Doesn't matter. All I need to do is establish either the long or the short, depending on which direction I'm headed. Okay, and then manage risk. Okay, so what this looks like then, and the reason that this works, are concepts called price exception and price rejection and price acceptance, rather. Okay, so here we're going to talk first about price acceptance. All right, and then we're going to talk about price rejection. Okay, all right. Price acceptance occurs when prices hit a level and then maintain that equilibrium. Okay, so given standard deviation, then they're stuck within the deviation. Rejection is basically your expansion. Okay, now that can be difficult to model, but you don't have to. So rejection occurs. Let's say we're moving down. Rejection occurs. Then we hit this area of acceptance at a lower level. And then we may break out, we may move one way or the other. This price acceptance, though, is going to occur within the mean of our average. So unless there's some extreme deviation, and we can always manage risk, unless there's an extreme deviation, then price should not return to the initial levels. Okay, so now that we understand that, we go back and we look at this. Again, we look at our signal line. We get our trend change down. Okay. Now, as price oscillates around that mean, okay, I can establish my low risk shorts very early in the cycle, and I can manage risk. I can get to BE, I can use price action, and I can manage my risk. Okay, so now, but you're saying, well, these prices just come back, it might be range bound. Yes, this is true. However, keep in mind that as price moves, so this is what it looks like in theory. But what actually is happening here is price is doing this randomly, okay? So as prices move lower, you can see I get my rejection here and my acceptance at lower levels. This is really, really key. Because once I have acceptance at lower levels, then deviations from the mean will not return me to my risk window, which is up here, all right? So a standard deviation from the new mean, which is down here, because keep in mind, means are always moving because they're taking on different prices as they move along. So once I manage risk and then I no longer have any theoretical risk, then I can allow this to trend out. This could go indefinitely into a period of divergence or reversal, whatever. This doesn't really matter. But as long as each level I get price rejection and acceptance, even though it looks like this, it doesn't return to my mean. Now, that should right away you should say to yourself, well, geez, well then this is like a tool for big expectancy. Yes, it is. So what happens then is when we look at this, we can establish the same risk gain that we've been talking about. So we have this risk gain here, big risk gain of just 1 times risk. That's all we're gonna do. We're gonna take 1 risk, 1 R. So that's an R. But we have the expectancy, if this trends out, to go 5 to 10 R. Pretty cool. Okay, so if you think about it, all you need to do is establish a solid mean reversion model, take the early entry, reduce and eliminate risk early in the cycle, which is not difficult to do, and then you never have to worry about direction. Hey, if it doesn't go, it comes back, breaks even, yeah, it happens to me all the time. I can't worry about it. If it does trend out, then I can hit my targets, and then my winners are always much, much larger than my losers. This is why direction is the key, and trending markets or sideways markets don't matter. It doesn't matter. It doesn't matter what it does. It's either going to hit its objective or not. So now you should have a much better idea about the concept of mean reversion, why you can use it to trade for direction, why it's easy to set up every trigger for direction like I do. I don't care if it doesn't go anywhere. That's what risk management is all about. Okay, that should do it. Now you never have to worry about your neighbor telling you it's a range-bound market, it's a trending market. You don't even have to sweat it. That does it for me. My name is Frank Bunn. Y'all have a good day.